The first thing people need to ask the question, be that 6 or 8 year old and ask the question, why? How can a 3% mortgage rate equate to hundreds of thousands of dollars of interest? Now, we know the hundreds of thousands of dollars of interest is there because we have documents, like this. This is the loan estimate. This is the third page of the loan estimate. I've got highlighted here total interest percentage, right? This is based on a 3.875% mortgage rate. But at 3.875 on a $165,000 loan, the total interest percentage is almost 70%. Now, how can that be? We are disclosed that, hey, if you take this 3% loan, let's say it's $300,000, you're going to pay, let's say conservatively, $200,000 in additional interest, right? So you're going to pay $500,000 for this home. So we need to ask the question, okay, but I thought I was only paying 3% in interest. So how does 3% in interest equate to $200,000 of interest? And it's all based on an amortization schedule. We focus too much on the interest rate and not the total interest paid, or what we call, what is your rate of interest, not your interest rate. And again, that's where TIP comes in, total interest percentage. Here's how you come up with that number, just for those watching that want to understand their own disclosures that they signed at the closing table when they got their mortgage. Everybody signed this. It's a loan estimate. It's on the third page. You take $200,000, and that's the total interest you would pay over the life of that loan. Divide it into the original loan amount, which is $300,000. So in that case, that's 66%. That's your TIP, 66% total interest percentage. So what that tells us is that time and balance is far more important than what the interest rate is. So we pound our chest thinking, oh, we're only paying 3% interest. No, we're paying hundreds of thousands of dollars in interest because it's taking us so long to pay off that $300,000. We're stretching it out to 30 years. Balance is also more important than interest rate. I'll give you an example. Let's say I offered you a $300,000 mortgage at 3% and a $200,000 mortgage at 4%. Now, one has a higher rate, the $200,000 does, but which one do you think you pay more interest on? The lower rate, because the balance is higher. $300,000 at 3% is $9,000. $200,000 at 4% is $8,000, right? So you're actually paying more interest on the higher rate because the balance is higher. Now, let's also use another scenario. Let's say I gave you two $300,000 mortgages. You pick one. You pick a 30-year and you pick a 15. Now, the 30-year is 3%, the 15 is 5%. Which one do you think you pay more interest on? You actually pay more interest on the lower rate because it's stretched out over 30 years versus the higher rate that's only at 15 years. Now, the reason why most people don't take a 15-year term is because it jacks up your minimum monthly payment. You go from $1,200 and some odd dollars a month to $2,000 a month, and people don't want to stress their monthly budget that much, so they don't opt for a 15-year term. Not that that's the solution either. It's better than a 30 because if you can afford it, it's going to cost you significantly less in interest to do the 15-year term, but what you give up is liquidity. That money is now going into the coffers, to the bank's treasure chest, and you don't have access to it unless you refinance or sell, or the third option is you get a home equity line of credit, right? That is simple interest, and you only pay interest on what you've actually borrowed. And it's open end, meaning money can move in and out freely. So that's why we bring in the alternative and say, okay, if that's the solution, then what does it look like if we adopt a cash flow strategy? Not just a tool, a financing tool, but an overall strategy of where we put our cash. Because the other problem is that mortgages were created to create checking and savings accounts. Most people don't know that. That right there is probably a mic drop and a huge golden nugget for people to understand. Mortgages were created to create checking and savings accounts. Because prior to 1913, a mortgage was a liquid product. Money could move in and out freely, 24/7. We live in a digital world today where it's a lot more accessible. When I say 24/7 there, I'll give you an example. You have a farm prior to 1913, the value's $200,000, you owe $100,000. Today, you could take the horse and buggy down to the bank and say, I want $10,000 to buy farm equipment. And when I get that $10,000, I'm going to buy farm equipment to cultivate more crop. When I cultivate more crop, I make $20,000. Where are we putting the $20,000? We're putting it back into the mortgage because money can move in and out freely. Banks were common sense banking back then, right? Nowadays, the only time you qualify for a loan is you can prove that you don't actually need it. Back then, it was like, we have collateral. We got secured collateral. We got a $200,000 farm. We're good. We know we're eventually, if you don't pay us back, then we get 200 grand versus the 10 grand that you borrowed from us, or the 110 grand that you borrowed from us. But since it was liquid, money could move in and out freely like that, the farmer had the confidence to put the 20 grand back into the mortgage. So if you follow the math, you got 100 grand that you start off with, you got 10 grand from the bank to get that farm equipment, but you made 20 grand you put back into the mortgage, and it now becomes 90. So we weren't putting it in a bank because we didn't trust the banks back then, because banks were defaulting right and left. You had to run on the banks. We didn't put it under the mattress because, you didn't have the security systems and Arlo and Ring and all that on your doors. So we didn't trust putting it under the mattress because, some Joe Schmo out there could just walk in your house, stick a gun to your head, and take all the cash out from underneath your mattress. So where do we safely put it? We safely put it in our mortgage because we had the confidence that anytime we needed access to it, we did it. That's all we're doing. We're going back to basics. So we introduce not just a better financial tool, which is a line of credit because money moves in and out freely, but we also adopt a cash flow strategy. So this isn't a payment strategy. This isn't just paying extra. We are bypassing the banks because mortgages were created to create checking and savings accounts. Because once the modern day mortgage came about and it became closed in, where money goes in freely, but it doesn't come out freely, what does that force us to do as the average American? Well, we got to put our cash somewhere, right? Okay, so now, since we can only put some of our money into the mortgage and not all of it because it's no longer liquid, we have to leave money aside somewhere for operating expenses. Gas, groceries, eating out, vacations, whatever, car breaks down, you need a new horse. I'm thinking back in the day, right? So we didn't put it in the mattress, we put it in our mortgage. But once a mortgage became a closed-end product, that meant we could only put some of our money into it. We're not going to put 100% into it. We got to leave money behind somewhere. So where did we leave it? In the welcoming hands of the banks in the form of checking and savings accounts. That's why in the 30s, they changed the way mortgages are done in this country, potentially forever. It segregates and separates us from our cash, and it props up the banks because now they grow core deposits. They create more checking accounts, more savings accounts. We got to put more in there because we got more expenses. So we're not paying down our homes. We're socking it in a checking and savings account. And the reason why this is an additional compounding issue is, what is the banks giving us for our checking and savings accounts? Next to 0%. It's terrible. I had this conversation a couple months ago with our banker I won't say the name of the bank, but we got a business account, and I look at it and we're getting 0.05%. Now, we're a business. We're not the average American. We have decent money sitting in there earning 0.05%. That's robbery. Now, I don't fault them. We're the stupid ones that should have been paying attention and not doing it, but we finally caught on. Like, no, that's got to get fixed. We're not doing that. We're going to move it somewhere else. That's how banks make money. So they're giving you 0%. But that 0%, it doesn't mean it's just sitting in there and not growing. It's actually sitting in there and dying. Because what do we also have? We have external factors like the cost of goods and services that's called inflation, right? That's the buzzword for the last, probably 4 years now, is inflation. Cost of goods and services are ever increasing. So if the average historical inflation rate is 3.3%, but you're getting 0.17% on your checking account, well, that's a negative rate of return. Your money's not even keeping up with the rise of cost of goods and services. So what is that negative rate of return? This is what's mind-blowing. It's negative 1,841%. That's what we make. So we think our checking accounts and savings account is responsible. Let's grow that. That's an asset. The more we have in there, the more of an asset we have. It's the opposite. The more we have in our checking and savings accounts, the more of a liability we have because we're getting a negative 1,841% rate of return. Okay? So we bypass the banks. So instead of having our money sitting in a checking and savings account, we have a cash flow strategy. So instead of putting all of our money in there and then segregating it towards the mortgage, to the student loans, to the credit cards, to the car loans, then we got a savings account that's, for future retirement, for a vacation fund, for an emergency fund. All we're doing is constantly chopping it up, making it less efficient. Instead, if we could just keep it all together and laser focus it into the line of credit instead of a deposit account, now essentially what you're getting is whatever rate of return or whatever interest rate you have on the HELOC is also your rate of return on your money, because a dollar saved is a dollar earned. So let's say the HELOC is 5%. You put 10 grand into that home equity line of credit, you're essentially making 5%. Does that make sense? Because you lower the balance by 10 grand, but it's still liquid. And the other thing that most folks don't understand is these lines of credit, they work no differently than a checking account. See, we put money in a checking account. I just had this conversation with a potential client 2 days ago that she was trying to grasp this information. Here's the other thing that's ironic. Banker with one of the nation's largest banks for 17 years. And this is the first time she's ever hearing this information, right? You just don't know what you don't know. The other thing about lines of credit, when you put money in, it goes to principal first and interest last. Here's what I mean. Let's say you start off with a $100,000 balance. You put 10 grand in. Your balance is 90 grand the next day. But the bank is then charging you interest on 90 grand, not the original 100,000. A mortgage is opposite. When we put money in, it goes to interest first, then the principal reduction is what's calculated next. It's called an amortization schedule. So back to the cash flow strategy. Since we know the line of credit is liquid, having the conversation with her is like, why do you put money in a checking account? She's like, because I know it's there for a rainy day. If I need access to it, I've got access to it. I was like, you do inside of a line of credit. These banks are giving you debit and credit cards associated with the account that you could go to the ATM, withdraw cash. You could use that same card to purchase groceries, milk, eggs, whatever. You go buy a car with it if you want to. You can buy liabilities with it. You can buy assets. You can do whatever. It's your money. It's just as liquid. You got online bill pay, so you could automate your expenses to come directly out of the home equity line of credit and get paid by the home equity line of credit. You get check writing capabilities on it. You have all the same tools with that line of credit that you do with a checking account. So instead of storing our money in a deposit account where it's earning negative 1,841%, it's actually eroding in value while your money's being segregated and you're only putting a portion of your money towards debt. Now you can put 100% of your income towards the debt, but it still maintains liquidity so that when you need to pay the other bills, they still get paid. And in what you naturally save over the course of a month, because you're making more money than you spend, guess where it sits? Inside the line of credit that continues to suppress the balance month after month after month. And when the lower the balance goes, the payment gets recalculated based on the new balance. So what do you think happens to your payment? It keeps going down. But if your income stays the same and the payment goes down, that much more goes towards principal. This is why it has a compounding effect to get paid off so quickly. And that's why people think it's too good to be true, to stay on your same budget, same expenses, same income. Would it be great if people cut expenses? Yeah, all right, great. You just put it on steroids. But with the same budget, they're taking the same income and expenses and getting their home paid off in a fraction of the time because they're wiser with their money. They're not losing almost 2,000%. They're actually making money, and it has a compounding effect. And the interest is calculated different too. So that helps as well.